Welcome back to another episode of SaaS Buyers Club. I'm your host, Omeed, and I'm managing partner of Optimist Legal. Optimist Legal is a full-service corporate boutique law firm where we help SaaS founders with all things contracts, from incorporation to exit. Anything that has to do with contracts, we help SaaS founders with. I'm also the host of the SaaS Buyers Club podcast, which you're watching right now. And the mission of the SaaS Buyers Club podcast is to help founders get better exits, because I believe anyone that can give value to SaaS founders that help them increase the value of their business will help them get a better exit. With that being said, I'm super excited to introduce Kirk Michie. Did I pronounce your last name correctly?
Close enough, man.
Okay, cool. Kirk is the managing partner of Candor Advisors, and he has 3 decades worth of experience collaborating with founders to achieve their strategic objectives, helping them get better outcomes, which is exactly the mission of this podcast. So I'm super excited to welcome you to the show, Kirk. Thanks for joining.
Thanks for me. I'm really happy to be here.
Awesome. So what's your hot take, Kirk? What do you want people in the audience to get from the show today?
Yeah, so without being too controversial, I would say it's good for any founder who's thinking about selling or having a capital event that your investor or your buyer is a full-time predator. You're part-time prey. You need to armor up. You need to protect yourself. You need to have some guidance around the transaction. Doesn't mean you need to hire an investment banker, but you should probably get a knowledgeable lawyer involved in whatever you do to make sure you don't agree to terms that are unfamiliar, and absolutely don't use hope as a strategy. If you get an LOI, don't sign it. The LOI is a ceiling. It is not a floor. You know, the buyers aren't bad people. It's just they've got a different objective than you do as the seller.
Cool. So that's some King of the Jungle shit. I love it. And also I love the Peter Thiel reference there as well. Hope is not a strategy.
Yeah.
Okay, buyers are predators and you are part-time prey. So I heard you give one example of that. LOI is a floor, not a ceiling. Don't sign it until you make sure that you have people negotiating on your behalf. Talk to me about that.
So the LOI is a ceiling, not a floor.
Yeah.
Yeah. When I say that the buyer is a full-time predator, what I mean by that is whether they're a strategic buyer, like a company in your business, or a financial buyer, a private equity firm or a search fund or an independent sponsor. They do this all the time. So when they reach out to you and say, hey, send us over a QuickBooks download because we've been, tracking or did some research on your business and you're exactly the kind of business we want to buy, and you get really excited about it, you think that their requests are heads up business people collaborative kind of discussion, and that what's going to result from that is some fantastic, amount of cash and prizes. And all you got to do is provide them with a few additional bits of information. A wire transfer is going to happen to your account. And that's just not how the process works. The first thing is, if they're a financial buyer, they're looking to, if they want to acquire your business, and you provide them with information that says the transferable economics are as attractive as they think they are, then just like when you walk onto a car lot, having decided that new big Range Rover or G550 Mercedes, or for that matter, the newest Prius, is exactly what you want to get. You want to pay as little as possible for it, right? They're going to do the same thing with your company. They're not bad people, but if they're investing money on behalf of investors or shareholders, then it's their fiduciary obligation to buy your business for as little as possible. And that is not the same as your objective in exiting. And they're going to do that by structuring the deal so they put as little equity as possible to try and create leverage and higher return for them and their investors. Doesn't mean they're going to be reckless with it, but they're not going to put more equity than they need to in the deal. They're going to give you as little cash as possible because they don't want to fully take on the risk of running your business. They'd like you to keep some of that risk and de-risk it for them and their investors. And so they're going to probably use a number of structure elements. So as little cash disclosed as possible, as many contingent payments as possible. So that might be earnouts, it might be a seller note, it might be rolled or retained equity. But so you as the seller have not heard those terms before. You've been busy running, your machine shop with 4 different locations, or your injection molding business, or, your, chain of 25 tire stores and you just don't know these terms, right? So that makes you part-time prey. You're
Mhm.
now in a world that you just, kind of have no familiarity with, and you're a savvy business person. But the M&A world is a totally different thing.
Totally makes sense. So, yeah, talk to me about some of these structural elements that you mentioned. How have you seen them put into play? What should founders know about them? And how, outside of, if they were to hire, for example, Candor, how do you help negotiate those various structures to help them get, you know,
Yeah.
the highest ceiling possible, which I also want to ask you about. But yeah.
Yeah. So, like both your business and your podcast, we're trying to guide founders to the best possible outcome, whether that's an internal sale, like to an ESOP, or developing, kind of a successor and becoming an LP in your own business, or an external sale to a strategic or financial buyer. When it's an external sale, what we're trying to maximize for is the highest possible amount of the proceeds coming to the seller at the earliest possible moment.
Mhm.
Think about discounted cash flow analysis. Think about getting as much money as possible, creating the shortest duration window and the maximal risk transfer to the buyer.
Mhm.
So to do that, we're going to use a framework that we call kind of, seller's price, buyer's terms, buyer's price, seller's terms. We're going to negotiate in a heads up way. We're going to tell our buyer what we're trying to get to. And what Candor is going to do, if we're involved, is to make sure that we explain to the founder on every trade-off, kind of what they can negotiate for next. So, think about it this way, that, if a buyer comes across with a letter of intent or indication of interest, and that's the point at which we're retained, and there's sort of a general, like, maybe the buyer says that the business is worth $25 million based upon $5 million worth of EBITDA and the relative growth rate in the sector.
Mhm.
And let's say that we at Candor look at our databases and all the precedent transactions we know about, and kind of incorporate our work and say that might be a reasonable number, as long as the bulk of the transaction is in cash. But the buyer has put an LOI together that says we'll give you 60% of the purchase price in cash up front, and the rest in a 2-year earnout based upon the pro forma forecast that you sent over to us.
Right.
Okay. Well, the pro forma forecast that they asked you for as a business owner is a trap. Most businesses that have been around for any length of time, that were started by entrepreneurs at their kitchen table or in their garage, don't run based upon looking at the total addressable market, the serviceable addressable market, and iteratively developing a forecast or a budget for next year. When they said to you, when they reached out, hey, can you give us the last few years worth of financials and a forecast for next year or the next couple of years? And you knew that you couldn't show them a flat or down year next year because that would make your business seem less attractive. So you went, I'm going to grow at 10 doesn't seem enough. So, and 20 seems too aggressive. So I'm going to put 15% in there. And so then what they say to you is 40% of the proceeds on this business that you've been running for the last 25 years, building, having the existential risk of running and making payroll all the time, 40% of the purchase price is coming to you based upon the achievement of some forecast that you did on the back of an envelope last night. And they're going to take advantage of that. So the first thing we're going to do as the advisor is say, yeah, no, we're not going to do an earnout. Or if you want an earnout, we want more cash up front, and we want the earnout based upon, future growth, but we want it uncapped.
Mhm.
So
Mhm.
we want it over a longer period of time, and we want it incrementally, right? So we don't want it all or none, and we want to make sure. And the conversation we're having then privately with our client, Omeed, is to say, assume you're never going to get any part of the earnout.
Yeah. Most don't.
Most don't, right? I mean, I had coffee a couple of weeks ago with an M&A attorney who's been working as a partner in his firm for the last 25 years. I asked him how many times he's seen businesses get their full earnout. He said maybe 20%, right? So we counsel them, hey, look, let's assume that you're not going to get any part of the earnout. Can you live with the initial cash proceeds if it never happens? We're not saying don't agree to it, but let's make sure that we're getting enough up front so that if you never get the earnout, you're still okay that you sold to these people. Because I promise you, if they're a private equity firm, probably within a year, you're not going to like them very much anyway, because they're not operating people. They don't speak your language, right? So, that's an example. Probably a
Right.
long-winded one, but that's an example.
That's perfect. I want to talk to you about the ceiling piece. Actually, the reason why I called it the floor was, well, so the LOI, you described it as a ceiling. And I actually would like to get a different definition of what you mean as a ceiling, because
Yeah.
by ceiling, do you mean that this is the most that the buyer is willing to pay? Because if that's the case, then what are the tactics other than the one that you have suggested in terms of, hey, give us more upfront, let's reduce the earnout amount, and actually let's make sure that we're completely comfortable with making sure that if you never earned the earnout, then you'd be okay with the ultimate purchase price? Because to me, that actually means that the ceiling is kind of movable. So
Yeah, great question. I'm glad you're drilling down on that, because what I should probably more precisely say is the signed LOI is the ceiling.
yes, that for
Or
sure.
as a another M&A lawyer I know says, it only gets worse after the LOI is signed. Which is to say, look, if you agree to an LOI based upon the QuickBooks download you sent across to them that shows your P&L without any awareness that you need to adjust your P&L, your net income, to an EBITDA number, which adds back, your interest, taxes, depreciation, amortization, and your non-recurring items. And it looks at things like, should you be amortizing certain expenses and capitalizing other ones? If you haven't gotten that feedback yet, and what you sent across to the buyer was just a QuickBooks download, and they made a few tweaks to say, here's what we think your EBITDA is, and you agree, they're not going to allow you after the fact, if we get retained, bring in a good accounting firm to do quality of earnings, to look at your financials and come up with an EBITDA number from your net income and create a bridge. We're going to have to fight with the buyer over increasing the purchase price, because we're saying we agree with the multiple, but you got the EBITDA wrong, right? So if we step in beforehand and we say, listen, we can show you, what the net income looks like, but we haven't done an EBITDA. So we're not going to agree to a deal based on adjusted EBITDA until we get that work done. If you want to give us some time to work with our accounting firm to do something, happy to do it, right? Before the fact, they might not like it, but, in some ways, and this might be kind of an imprecise analogy, but like, if you're wealthy and you're marrying someone who's not, and you want them to sign a prenup, a court would tell you that that prenup is not enforceable if the non-wealthy person marrying you didn't get good counsel. That prenup will not stand up if they didn't get good counsel. The smartest thing you can do if you're in that scenario is to recommend good counsel to the person you're asking to sign the prenup. In the same way here, any buyer who, wants, a prospective client retains you to say, hey, will you take a look at this LOI and mark it up for me? And you come back with that kind of feedback to say, you need to do adjusted EBITDA, you need to tweak here, you need to change this. Any buyer that you scare away by doing that work, or your client scares away by saying, we're going to bring in Omeed to do this, was not a legit buyer.
Agree.
You just saved a lot of heartache. You didn't miss out on a big payday, but you did save losing a lot of, maybe millions, maybe tens of millions of dollars on your sale, because any buyer that would scare away is not a legit heads up buyer. They're trying to steal the company.
Yeah, I've never understood founders that get approached by buyers and the buyer's like, "Oh yeah, like, don't talk to anyone about this."
Yeah.
Like, I think that should immediately be a red flag. Like, um anytime or oftentimes we'll also see brokers that are like, "Oh, you don't need a lawyer. Like, don't use a lawyer. Just use these forms. Like, just sign the forms."
Yeah.
Oftentimes in the smaller deals, usually this is usually in the like, purchase price 1 to 2 million. Oftentimes we'll, these kind of long-standing brokerages, oftentimes in Main Street deals, for example, we'll see a lot of
Yeah.
that. But I think that should be for sure, as you mentioned, like the number one red flag. Like if the if the buyer is telling you not to seek advice and to just like trust them, like definitely run
Yeah.
in the opposite direction and cover your
Yeah.
bases. So 100%
And
aligned there with you.
you nailed it. I mean, I'll tell you that whether in small deals and big deals, I think you're absolutely right. I mean, you sort of picture the wolf in Little Red Riding Hood in Grandma's
Yes, that's a
nightgown
perfect.
and sleeping cap, saying, "We don't need lawyers or transaction advisors involved in this deal." Look, I was on a call in a deal that resulted in a pretty big 9-figure sale of a business where the CEO of a $12 billion public company said, hey, look, guys, we do this all the time. We don't need a bunch of lawyers and accountants in here, and we don't need transaction advisors. And one of the things I will tell you is that on the call on his side was his general counsel, his outside counsel, um, and
Lawyered up.
a former McKinsey partner who did nothing but transaction advisory services, who was in charge of corporate development. And so he in effect had two super lawyers and an investment banker in house telling my client, "Hey, we don't need a bunch of lawyers and accountants on this deal." And this is the guy who's a billionaire who's running a $12 billion company. Whenever somebody says that, think, okay, in whose interest is it?
Yes,
Right.
exactly.
And so if in that deal, there was about ultimately around a 50% increase in purchase price and a dramatic change in terms just by getting lawyers and transaction advisors involved.
Mm.
A deal's, a founder friendly private equity firm is never going to give their best possible offer to somebody without lawyers and transaction advisors involved. Just doesn't happen.
Yeah.
Why
You
would
gotta
it?
you gotta
Why would
fight
it?
for it. You got
Why would it?
yeah.
Yeah.
I mean, their whole model is, you know, uh, optimize, cut cost, pay as little as possible. They're out there to get great deals.
Right.
So, yeah, if you don't have people on your side fighting for that, then you're gonna fall into their model, which is the very basis of the buyer of your business is a full-time predator and you're their part-time prey, which I'd love to dig into a little more. Is there anything else that you can tell me about? Is it trademarked or is you just like TM it just because like
No,
you
it's
want to?
actually trademark. We have a US TPO number on the buyer of your business as a
Okay.
full-time predator and your part-time prey.
Yeah.
I don't intend to spend a whole lot of time, effort, energy, or money
Yeah.
defending it.
Yeah.
If 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 Scott Galloway and Brene Brown and Tony Robbins start using that terminology, I, like Simon Sinek, will be thrilled when people say, find your why.
Yeah.
And Simon Sinek was even more courageous than I was in that he never sought to protect that intellectual property because he thought that might limit its reach.
Mm.
I aspire to be as trusting and bountiful as he is.
Yeah. Do you remember what class of goods like, is it t-shirts or like,
Um,
digital?
No, no, it's in printed material and promotional
Okay.
material, and I don't like. I think if somebody titled their book anything close to that, we'd probably have
Gotcha.
a an actionable kind of thing. As to whether we would ever do it, I don't know.
I wasn't sure if there was like merch or something out there that because I like, these sorts of things, I love rocking, hats and t-shirts, so I'm here
Yeah.
for it. But yeah, go ahead.
Yeah.
What were you gonna say?
Not yet, but one of the two members of my advisory board said, that's at least $100 million idea. You should protect that. And I take my advisory board's guidance sometimes kicking and streaming, and other times because I completely agree with it right off the bat. That one just felt neat from a ego standpoint to
I get
have
it.
the
I get it.
trademark.
Yeah,
You know,
I love that.
yeah,
So yeah, what else do we need to know about the buyer of the business being a full-time predator? I understand that the core of the concept is buyers do this all the time. You're a founder in your lifetime. You may only sell a business a handful of times. So they're
mhm,
just going to have a lot more experience than you. They have robust teams. They have financial diligence teams, marketing teams, operation teams, legal teams, so on and so forth that literally
yeah.
come in and dissect your business and analyze every piece of it. Whereas, you are just the founder of your business. And so you may not have that much experience selling your business. So what
Right.
else is this concept made up of?
Yeah. So I would draw distinctions between the two kinds of buyers. So if you have a strategic buyer, a company that's like maybe a mega version of your company, or maybe a company that's kind of adjacent to your business and they're adding, products or services or geography by acquiring you. A strategic buyer is typically not as good and systematic at putting together their offer and doing due diligence as a private equity firm would be, but they're better buyers of businesses in the sense that they know when to stop asking questions,
Mm.
and they know when they've learned enough, and they know when they've de-risked enough to be able to integrate the business in. And they're probably, because their cost of capital in many cases is lower, especially if they're a public company, um, they've already done kind of the analysis on, let's say if they're paying, 8 times for your business, and their public market multiple is 15 times. As soon as they load your EBITDA into their P&L, they get an immediate, double on whatever price they pay for you. You don't get credit for that, but they know that they don't have to ask the nth degree or grind or try and screw you on the working capital calculation or something like that to make a ton of money on just getting your business into their business.
Mm.
Um, where they're predatory is not really being clear with you about what's going to happen after the sale and what's going to happen to your people. And there's going to be this big clumsy all hands meeting where their head of HR and their CEO act like they're really magnanimous and stuff like that, and they talk to your people about how this is going to be a great marriage, and they really value the company and the culture and blah blah blah. And 6 months later, your culture's gone and you're part of this big maw, and you've been an entrepreneur with no boss for 25 years, and now all of a sudden you've got some mid-level executive who couldn't carry your gym into a customer meeting, or your gym bag into a customer meeting, and now you're reporting to that person. Well, it's not going to work out, right? So you don't know that going in, and that's why you're part-time praying,
Mm.
right? With a financial buyer like a private equity firm, they're going to tell you that some version of, we're going to add our capital, our strategic guidance, our operating expertise, and our relationships. We're going to build this. And the second bite of the apple for you, because we're asking you to retain equity, is going to be even bigger than this first chunk of cash we're giving you. We're going to build the business together. We're going to be a great financial partner. You're going to be the operating guy. We're going to be the financial people, yada, yada, yada. Well, look, if you take their capital, you sure as hell are going to get their strategic guidance. You have no choice but to listen to them if they own the majority of your company, right? Operating expertise, they don't have any. I don't care which private equity firm we're talking about. They don't have your operating expertise.
Mhm.
They might have some useful operating experience. They might have worked in other companies. They might have even they might have an operating partner that comes in from time to time. And, he's both a spy and he might actually be a decent coach. But generally speaking, they're looking at your business and they're going to make their offer based upon the transferable economics. In other words, the cash flow, the EBITDA, right? And they're going to try and capture those customer relationships and the way that those customer relationships persist. And they're going to try and generate kind of a 2.5 to 4x or higher return on the money that they invest in your business. And they're going to try and do it in 5 to 7 years or less. Right. And that may be doable. Maybe there's some low hanging fruit that you missed as an entrepreneur, and that may be actionable with more capital and the ability to hire more salespeople or develop some strategic partnerships, or to, kind of build out your supply chain. That may be doable. Absolutely may be doable. But they're going to structure the deal so that from a risk capital standpoint, you still bear a lot of that risk. And that's what I mean by predatory there.
Yes. And so in that instance, that's where you come in and you push the buyer more capital up front, make sure that the founder is comfortable with the purchase price, minus never earning the earnout. That's the strategy there.
Yeah. So what we do, it's an interesting thing. At the client level, we play 3 different roles. We're guru. I mean, we know things they don't know. We're guide. We have the experience, the useful scar tissue of saying, hey, we've seen people in the past come to this kind of inflection point. Here's how we've seen them make the best decisions about this. And here's how you should think about those things. And then we're gladiator. And a lot of people think I mean that, like, we fight with the law firm to keep their fee down, or we fight with the buyer. We might, but I'll tell you what I mean by that is we fight with current you, who's your own worst enemy, on behalf of future you, the one you've told us you want to be when you retire or be finished with this thing. We tell you what things not to react to, which things in what appear to be really invasive and accusatory due diligence are just normal. So don't worry about it. And then we will also tell you which things are what we would call non-market or oddball things that we think we ought to dig into. And on the buyer's side, what happens with us is that we speak their same language. And while I may from time to time play the designated asshole, I'm likable and I'm knowledgeable. So the buyer can't blow me out of the deal by trying to communicate with my client directly and say, your investment banker doesn't know what he's talking about. Look, I've been a partner at a buyout firm. I've been involved in a lot of deals. We don't get steamrolled. I don't care how big their law firm is compared to ours. I don't care which investment bank they're using compared to ours. We don't get steamrolled because we know the essence of the deal. We also know that for our client, that the key animating factor is their why in selling. So look, if they have shared with us that they can't imagine running the business for 6 more months, much less 6 more years, well, whether we tell the buyer that or not, you bet we're going to pick our buyer based upon the idea that if our client wants to exit the business ASAP, we're going to structure the deal so that they don't have a bunch of contingent payments down the road and they don't have to keep running the business. On the other hand, if they truly want to play for the second bite of the apple and they think a new financial partner could help get them there, we're going to make sure that we understand at a really specific level what the buyer's track record is. Because if our client is selling a $25 million business and taking 40% of the proceeds in equity in the combined entity, we want to see a track record. I don't mean resumes. I don't mean the stuff that's on the buyout firm's website. I want to see internal rates of return and multiples on invested capital. Why should my client take this big chunk of their net worth and invest it with you? What my client has built up a business that's worth $25 million. We all agree on that because we've signed the LOI. Why should he take, 8 figures and reinvest it with you? I want to see your track record.
Yeah.
And we have been in conversations where, the private equity firm was asking our client to roll a bunch of equity, and they took our client's lack of willingness to do that as a sign that he didn't have confidence in his business. And what we told him is, my client has a ton of confidence in his business. He doesn't have confidence in you. You have not demonstrated a track record that should make him believe that you can do what you say you're going to do. And just because you and your other propeller heads figured this thing out on spreadsheets and came up with the idea that it's going to be this massive outcome down the road, you might be right, but my client's not going to gamble, a business he spent decades building and 40% of his net worth on your hypothesis. We got to see a track record. right?
Makes sense. Makes sense. I mean, that's one of the, things that I always counsel founders with respect to is like if if it's an equity swap or they're asking for, rollover or anything like that, you have the right to do due diligence on the buyer the same way that they are doing due diligence on you. And I think that kind of blows some founders' minds. I think you should be doing due diligence on your buyer irrespective of whether that's the case or not. Even with the strategic, like you pointed out, I made a meme a few months ago. It was like a super popular meme. It's like that girl, and she's like, it's like this little girl sitting in a car seat, and she's like worried or scared. And the caption of the meme was, after you sell your company and you watch your strategic cut 20% of your workforce and completely, destroy the thing that you had worked so hard to build.
Yep. Yep.
Because as you mentioned with strategics, the story over and over again, with most founders is they hear one thing, the buyer's super excited about, some sort of vision, and then it just doesn't play out that way. And they, watch this thing that they work so hard to build essentially just be burned to the ground, which I actually want to ask you about. It sounds like with most strategics, what you identified as to how they're the full-time predator is how they obfuscate how they're going to handle the business after acquisition. So what do
Yeah.
you do in that respect? How do you help founders navigate that process?
Well, first of all, props on great 3-syllable word choice. Obfuscate is fantastic. That happens a lot. That's what we call gaslighting. Where the buyer is essentially trying to convince our client that what they say is reality. Look, we think if you run a successful business, you need to be focused on 3 things when you sell. The first one is price. The second one is terms. And the third one is legacy control. And we don't mean an egoic legacy control. We're not talking about, leaving the name the same so that your name carries on. Well, we're talking about your legacy. If you built a business, is your customer relationships, the products or services you develop that are unique IP, and your people, right? So if you're selling to a strategic, assume that your staff might be vulnerable, especially the people that the strategic has duplicated, right? If you've got a controller and a CFO and the buyer has a controller and a CFO, one of your people is going away. Maybe both of those people are going away. Your buyer's not going to tell you that before they do the deal. So, if that's not workable for you, then maybe a private equity firm is the right buyer because private equity firm has no operating people, no duplicated people, and they're probably going to want you to leave it intact. They might initially, if not long-term, add people. Strategic might add people too, but the strategic's already got a bunch of people. I mean, we've sold businesses to public companies that have tens of thousands of employees, and my clients have like 80, right? So, you just got to kind of look at, what reasonably is the buyer going to do with the business? And God forbid they should say something like, we're looking for synergies. I mean, we call that the S word within Candor Advisors. Like, I believe it could happen, maybe. But I'll tell you, I was at, Apple paid $1 billion for Beats by Dre, which is cool because it made Jimmy Iovine and Dr. Dre billionaires because they were already pretty wealthy, and the extra $500 million took them over I'm at an Apple store the other day, and I asked the gal, because I'm getting a backup set of AirPods, whether the Beats by Dre are comparable to the AirPods. And she says, they're good. And I'm like, are they better? She goes, no, they're just different. I'm like, so what do you have? She says, well, the AirPods connect really easily, and they're kind of, designed to work specifically with Apple devices and all that. So I get another pair of AirPods. Now, I bet if you go back and look at the press release of, the buyout, I'm not sure about this, but I bet you Synergy was somewhere in there.
Oh, yeah.
And Synergy would suggest that she has a different response on features and benefits and differences and unique characteristics and things like that. So we just say, look, maybe the buyer thinks there's going to be synergies between the products, services, people, whatever, let's not bet your proceeds on it. Let's make sure that's their risk, not your.
What would you say the breakdown is between founders who care, because legacy is something that you mentioned that is, important. Do you find that a lot of founders think about legacy in the sale process, or is this something that you have to educate them about?
Yeah, great question. So we sometimes have to clarify what we mean by it, but we don't have to educate them about it. They're thinking about it and they're wondering if they can do something about it. And we talk to them early in the process about, how important are your people to you?
Hmm.
We talk to them about considering making, transaction bonuses to key people. And if those people are key to the deal working and there's some contingent proceeds, to maybe do part of it in cash at closing and part of it is a retention bonus down the road, and there's a way to structure that. We talk to them about whether it makes sense to give transaction bonuses to people who are probably going to get blown out after the deal. And this is all with the eye towards legacy mattering, and people understand legacy is what you've built, the jobs you've provided, the families you've kind of given opportunities to, not like you're the king and you're kind of sharing with the serfs, but more of a be reasonable about what this buyer is likely to do and what their history is, some of which we can study. So go in eyes open, heads up. Don't make promises you're not sure you can keep, that might create legal problems for you. Say, I'm not sure what they're going to do to the people, but if they get rid of you, I'll take care of it. Don't say that.
Mm-hmm.
Don't know that. And that creates a legal liability, or at least something that's actionable. But, do kind of think about that. Do pay attention to, kind of who the buyer is. We've only worked with, we've done a lot of projects in just 5 years. We've probably, been involved in 60 or so, either consulting contracts or M&A deals. We are in some ways prouder of the bad buyers we've chased away than the deals that we've closed, because we got to preserve a better outcome for a founder. And we've only worked with one who didn't care what happened to his people when he sold. And we had a 90-day consulting contract, a month at a time. We elected at the, in the third month of that contract to take the 15-day notice in there to tell him that, we wanted to terminate the contract and we thought that he could find a better transaction advisor, that we weren't the right people. And it wasn't because we didn't have the subject matter expertise, and it wasn't because we didn't think we could create the right buyer universe and compelling materials and go out to market. We just didn't want to work for the guy.
Yeah, misaligned values.
Yeah, look, anybody that doesn't care about their people, it's not I don't get to be the person who decides who's a good person, who's not a good person. But I do know what matters to us. And I do know that if we're going to be in the trenches with somebody for, 9 months or more, we're going to want to like them, and they're going to need to trust us enough that we can have hard conversations with them. And that was just a bridge too far. We just didn't think we'd be able to align with that.
There's so much nuance in this conversation that I think is not talked about enough, especially I think a lot of founders don't understand the nuance necessarily between, strategic buyers and private equity and, and then even drilling down specifically with strategic buyers, in terms of how to take care of the individual people, thinking about how strategics, for example, might have a controller and a CFO. And so you're going to lose yours and who might stay, who might go. This level of nuance is, I think, actually quite unique in how to do deals. It's very detail oriented as opposed to, oh, you want to sell your company, here's a buyer. And
yeah,
I think that, for people who don't operate in the space, I think that is how a lot of people tend to think that the process might go, but it actually is it can be much more detailed than that. It can have much more nuance than that. And I want to talk to you about on the other side of things. So we talked about how to, do diligence on the strategic buyer, specifically around, those three things, which you mentioned were, I believe, price, terms, and legacy, essentially. Yeah.
Yeah.
And Then on the private equity side, where there's a rollover in play, doing due diligence on the buyer there, I heard you talk about asking, for example, to see proof of like IRR, the investment returns for the rate of return. What does that look like? At what point should a seller be asking the buyer, these sort of due diligence questions? Is it pre-LOI, post-LOI? Where should a seller be expecting to ask for that level of due diligence, and what does that look like?
Yeah, great question. So, coming back to where you started for a second, I would tell you that there are a lot of investment banks out there with equal or greater transactional expertise and more bench depth than we have. Where we excel is on the behavioral side and on the advisory side. I mean, it's like, look, if for the people on the call who are familiar with kind of great big name investment bankers like Ken Moelis, who has his own firm, it's a public company, or Frank Patrone, Catalyst, one of the great, kind of tech investment bankers of all time. Look, if you want somebody that's got sort of comparable deal skills to those firms, maybe certainly not the reputation and renown, but is a bit more Brene Brown or Arthur Brooks, happiness and, guilt and shame and, kind of getting to where Simon Sinek, Find Your Why. We're more that end of the spectrum. It doesn't mean that everybody we work with is all crunchy and does seances and stuff like that. But I will tell you that the nuance, it matters because so much of M&A is behavioral.
100%.
Yeah, and I would tell you that before signing the LOI, if there is a meaningful component of rolled or retained equity, we want to see the track record. We have, and look, if the private equity firm has limited partners, investors like, public pension funds or high net worth investors, believe me, they're showing a track record of some kind. It's reasonable for us to see it. We even will push a little further where a private equity firm is telling us that, they want to pay 6.5 times for our client and they intend to exit at 9 times. And so they're assuming some level of multiple arbitrage. We ask to see their financial model. And the ones that won't show it to us, I'm not saying it's easy to walk away from their deals, but I mean, come on. I mean, like, you want me to roll equity on and we have said no to 2 pretty attractive offers, 2 different clients. We found one buyer's approach, structure, and pricing attractive, and they had come up with a way to roll all of their portfolio companies' equity into one big pool. So our client wasn't just rolling equity in his own deal. He was getting a percentage of like 16 other transactions. And that sounded like a really cool thing. That sounded like, and from a tax standpoint, it actually worked. We had a tax person research it. But when we asked to see the portfolio marks and some level of kind of traveling, IRR, they wouldn't share it. And in the other case where our client was a strategic backed by a private equity firm that wanted us to roll a meaningful amount of equity, and we asked to see their financial model, and they gave us sort of a high level, just assume X and Y, in which case we restructured our deal to say, well, then in addition to the rolled equity, we want, a 2-year earnout because you've got a baked 2.5 turn arbitrage in there between 6.5 and 9 times. They wouldn't agree to it. And we said, well, if you believe that you're going to be able to exit at the number you said, and you think you should buy our client at much lower multiple than you're getting, that you've got a built-in arbitrage, why would you say no? And when the corporate development person at that firm said, well, we're not going to take the risk that we're wrong about the portfolio, about the multiple expansion. To which case we said, well, okay, then you're going to have to give us more cash up front, and we're just not going to agree to do.
Right.
And so on that one, our client has a really, really attractive business. There are plenty of other suitors, and we just said, look, we think you're the right buyer, but if you're stuck where you are, we can't do the deal. So, with the private equity firms, they ought to be able to share it, but I think they're so used to the asymmetric nature of the information they have versus what they're willing to share And they're also, in our experience, not deeply emotionally secure people in many cases. And they're not quite sure why they're as rich as they are or as successful as they are. And so they don't want to give away, they don't want to open the kimono a little bit because they're not sure if it's going to give away kind of the keys to the kingdom.
Right. They like the predator status that comes from like,
Yeah, they don't want to be called predators, but that's kind of the nature of a predator, right?
yeah, it's like I have this upper hand over you and
Yeah.
toying
Yeah.
with you because I know things that you don't.
Yeah.
Yeah.
Absolutely.
Anything you want to leave the audience with that maybe we haven't covered, like a last kind of tip or point, maybe something that you notice founders and you wish that they knew, for example?
Yeah. 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 So, we think of 6 secrets to a successful sale of a business, partly because we like alliteration and partly because, we've narrowed down to that. So, look, the first one is understand your why. Get a really clear handle on why you're selling the business. Whether it's retirement, burnout, opportunism, want to do something else, be clear about it. And then make sure your buyer aligns with your why, right? You don't sell to a strategic if you care about whether your people get preserved, and you don't sell to a private equity firm if you don't want to stay involved in the business and don't have a successor that they're going to accept as your replacement, right? And then make sure that your financials are professionalized. It goes back to what we were talking about early on about the adjusted EBITDA versus the P&L. And to that end, don't give up too much too soon. Don't share too much information. There is no reason that you need to get distracted in a conversation about buying your business and exchanging a bunch of information if they can't give you an indication of interest on valuation. It can be non-binding and really, really broad, but what are we talking about here? You don't want to be thinking you're going to sell your company for 30 million and find out that they were thinking they were going to buy you for 12 million and have exchanged a bunch of information, right? And so don't try and do this alone, right? Whether you hire Omeed or Kirk or not, at least go to your Vistage EO, YPO group, or peer CEOs and say, hey, have you ever sold a company before? What do you wish you'd done differently? How should I think about whether I sign an LOI? Which advice do I need? Which advisors mattered most to you? Definitely get some help. Whether you pay for it or not, get some help, some people that have some scar tissue. And then lastly, don't argue with the market. Look, there's a price for your business that's assigned based upon your transferable economics. I do not care how unique your business is. It's going to be bought as a multiple of its transferable economics. It will be that multiple will be increased by your growth rate and how unique your intellectual property and your growth rate are, but they will not sell based on those things. And then they will be decreased by your customer concentrations or your supplier dependencies or things like that. And so whatever the market tells you through some experienced transaction advisors that your business is worth, accept that that's the way your business is valued. If you don't want to transact at that price, there are probably some alternatives you can pursue, right? And dovetailing with that, whether you hire, Candor Advisors or not, like all of our stuff and 180 plus videos are in the insights section of our website, candor-advisors.com. But we also do free webinars every couple of weeks at EBITDA University. That's EBITDAuniversity.com, where we teach a lot of founders about the 6 secrets in more detail and do a live and free Q&A every couple of weeks. So I would leave them with that. But like our stuff's pretty easily accessible.
And I'll make it even more accessible by dropping it in the show notes below. So
Thank you.
happy to do that. Kirk, thanks so much for joining this week. Got so much out of this conversation. Always really enjoy speaking with you. And yeah, as mentioned, his contact information will be found in the show notes below. You'll be able to find the EBITDA University link in the show notes below as well. And for everyone out there, thanks again for watching. This has been another episode of SaaS Buyers Club. So, Kirk, thanks for joining.
Thanks, Omeed. Great being with you.
Awesome. See you next week, everyone.